Hey friends, thanks for coming. This video is for anyone who wants to impress their friends at dinner about their tax knowledge concerning REITs, anyone who's thinking about investing in REITs, or someone who just wants a clear understanding on what makes a REIT special. Right, top right in. So in summary, REITs are companies, right? They have revenues, they have expenses, and they have profits, right? The key thing here to remember for REITs is the tax and the profits, right? So REITs don't pay a corporate income tax. However, REITs are required to pay 90% of their taxable income back as distribution to shareholders, right? So the IRS says, hey, don't worry about paying the federal tax, but also you got to pay that distribution to shareholders, right? So awesome. Company pays no tax, pays you a lot of money back. Who doesn't want that? That's also the primary risk, right? So compared to, say, companies like Amazon or Starbucks or companies that you can think of that have built up over time, like a Google, who probably don't even pay a dividend at all, they typically keep the cash and continue to grow the business, right? So REITs can't do that because of this tax implication for them, right? So, and you can elect to become a REIT and you can elect to not be a REIT, right? You can de-REIT and elect to be a REIT. And so that's the key risk. And why is that a key risk? Well, as we saw in the global financial crisis, when the capital markets are starved and REITs need money, well, that's not a good recipe. And if you think about where you stand as the investor, if you're buying shares and not the debt, and I'm thinking preferred stock or common stock, the first place they're going to have to cut if they still have to pay debt, right? And I guess to really hammer it home for you, think of a REIT that owned office buildings or owned a warehouse, for that matter. Let me pick on industrial. Everyone's beating up on office. They own a warehouse, they lease it to Amazon. Amazon says, the REIT says, well, we bought this big warehouse and it's cost $100 million. And so that gives us $1 billion portfolio. So this is 10% of our portfolio. And we got a lot of debt, but we're going to buy this warehouse and it's going to pay us a lot of money. And then they find out that Amazon wants to leave, right? Their lease is up and Amazon decides that they weren't going to renew the lease. When they bought it, they said they were going to renew, but they didn't. Well, guess what? Now the money's not coming in. Taxes still got to get paid. Insurance still has to get paid. And maintenance has to get paid. Someone's got to go mow the lawn so don't get any tickets on the property. And that means that someone's got to pay that expense. And the only way to make those expenses balance out, because debt has to be paid, is to cut the dividend. And that's where the investor gets hurt. So they bring it all home. If there are variations in the income due to management or bad asset decisions, it does affect the shareholder at the end of the day, because the only place you really create opportunity for the debt to be paid is to cut out the dividend. So that's the real rub, right? So big dividend, but there's always a risk of not being paid, right? This slide here just goes over, just high level, the difference between the common entities used for investment in the U.S. So again, REITs have to pay 90% of their taxable income. They've got to hold real estate assets at least 75%. And on top of that, they also have to make sure that they have a certain number of shareholders, right? You can't just be a person to just put them all in the one bucket and say, this is all mine and this is my REIT and Family REIT LLC. Unfortunately, you have to have other shareholders. And to be a trust in nature, it can't be, call it, what's the technical term here, that people use and to impress your friends at dinner, closely held. There you go. So because of that, it's not an apparatus for, they call it the evil supervillain who's going to put all their assets into some tax deferred vehicle and not pay taxes. There's other things for that we can get into. Anyway, performance during recessions. So I think this is probably one of the more interesting slides, because I think no one really knows where we're going next, right? Interest rates have gone up a lot relative to where they were. So they're not the highest, but they're definitely gone up the quickest in quite some time. And I want to really focus in on, not the dot-com bubble so much, because REITs did fairly okay. And comparing this performance, we're comparing, say, the S&P 500, which everyone knows about, and the NAREIT FTSE index, which is an index, as it seems, of public companies that own real estate, so other REITs. And you can see in 2008, it wasn't such a hot time for REITs, nor was it for the broader market.